This week's market jitters come despite stellar earnings from some tech heavyweights. Before Apple, we also heard from Microsoft and Tesla. Those two companies also beat expectations. Tesla reported record revenue and earnings. Microsoft just had its most profitable quarter ever. And yet, both indexes they dominate, the S&P 500 and the Nasdaq, are having a miserable month. Dan Niles is the founder and portfolio manager for the Satori Fund, which invests mainly in U.S. tech firms, and he joins us live from San Francisco. Great to have you on the show.
My pleasure, Allison.
And I'm sure as much as investors want, the reality is Apple alone probably cannot hold up tech stocks, cannot hold up the Nasdaq as a whole. The thing is, with many of these big tech companies, there's nothing wrong with the fundamentals, is there? But there is this shakeout happening in the tech sector because of their lofty valuations. So as we see techs getting slammed and the Nasdaq in a correction, I want to know, is this the end of tech investing as we know it?
Well, it's a good question, Allison. I think it's obviously not the end of tech investing as we know it, but I think the way you need to think about it is you had $5.5 trillion of government stimulus come out since the pandemic. You had $4.7 trillion in Fed balance sheet expansion since the pandemic. And so you add those two numbers together, that's over $10 trillion coming into the market versus US GDP at $21 trillion. And some of that money went into buying stocks, others into buying cars, others into buying crypto. And now what you're seeing is all that money was chasing goods, but you didn't have 50% more goods. And so that drove massive inflation, which is what the Fed's trying to deal with. And now all those valuations need to come lower as the Fed is starting to deal with inflation at 40-year highs, which they didn't see coming, made a big policy mistake last year. And so the valuations have to come down for all of these names that got highly inflated.
Okay, so this is about valuations. So how are you valuing stocks? The push now seems to be to sell, anything that's unprofitable. But if you've got a long-term view, and there are high growth rates in unprofitable companies, even in the tech world, isn't there a tug of war between innovation and profitability at this point?
Yeah, I mean, I think, let me give you this analogy. If you go back to 2000, when the internet was first starting up, you had this company called Amazon, and it was trading at $106 a share in 1999. And from 1999 to 2001, the revenues went from 1.6 billion to 3.1 billion in revenues. The stock went from 106 to 6. So the stock went down 95%, even though revenues doubled. And that gets back to the fact that valuations were too high to start with. Not that e-commerce wasn't real. And if you look at things today, it's a similar situation where if you take the market cap of the entire stock market and you divide it by US GDP, you're sitting at about 1.8 times. The average over 50 years is 0.8. And this just goes back to the fact you had all of this stimulus, which was nearly 50% of GDP, driving up assets all over the world, including stocks. And now that the Fed is pulling that back, you're going to get the exact reverse, where valuations will go back to normal.
As you see it, what should be the number one concern for investors this year?
Well, I think, and we've written about this on our website, it's the combination of high inflation, an aggressive Fed, and slowing growth. And that's the exact combination you got in the 1970s. And we have some great charts on this, where you had to have the market multiple go from about 20 times on the S&P. It contracted all the way down to 7 times. And this offset 20% earnings growth over a 2-year period of time from 1972 to 74. And unfortunately, I think that's what you're dealing with. And on top of it, you had growth slow in the 1970s from very fast growth. And that's, again, what you're seeing, especially with energy prices and wages and rents as high as they are, which aren't probably going to go down anytime soon.
Okay, Dan Niles, founder and portfolio manager of the Satori Fund. Thanks so much for all of your great analysis.
Thank you, Allison.